Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is Market Today, a show where we'll help you understand the closing action on the D Street. Not really looking good. 7 days of a winning streak, and today it seems that we are giving up crucial, data points and crucial levels on the Nifty. 188 points lower in trade. We've slipped below 23,500 mark on the Nifty. We remember, tested 23. 800, and we kept on coming down starting the middle half of yesterday, and all of the day today it's been a choppy session for the markets. We have not been able to sustain, and remember, this comes right ahead of the series expiry, F&O expiry, that comes in tomorrow, followed by an upcoming long weekend as well. Now remember, barring auto space, rest of all of the sectors have actually lost in the trade today, and this is at the risk of snapping the 7-day of a rally that we were seeing on the D Street. So media stocks are down over 2% in trade. Oil and gas, realty, at least private banks, PSU banks. We're also seeing financial services. Over 1% cuts can be seen across all these sectors. Barring autos, rest of the sectors are all down. What's still holding up? Trent 3% higher at 5,340. IndusInd Bank about 3% up. HCL Tech, M&M, Grasim, these are the top 5 movers on the Nifty, while there are just a handful of them remaining. About 8-10 stocks that are on a higher side. Rest of the stocks have all slipped on the Nifty. NTPC, Tech Mahindra, Bajaj Finance also. Remember, this was the stock that got upgrades, and that also got vote confidence as far as many of the brokerage houses are concerned, but it's now giving up some of its gains. Axis Bank, Cipla, Apollo Hospitals, these are all the stocks that are down in trade today. On the F&O side, Siemens continues to hold up. HAL also up by about 3%. AU Small Finance Bank and Trent are the top movers, whereas IRFC, Max Healthcare, BSE, Zomato, NTPC, these are all the stocks that have declined in trade as well. So that's how markets are really shaping up today. Let's look at welcoming our guest on board to help us understand how to make sense of what's happening on the D Street. We have with us Mr. Sharad Awasthi from Smiths joining in. Warm welcome to you, Mr. Awasthi, and thank you so much for taking the time out. Well, it was sort of replaying a dream rally of sorts last 6-7 days, but again the brakes have been applied today. What's the sense that you're getting, sir? How should investors really read this? Is it just before the F&O expiry kind of a volatility playing out? Is the uptrend still intact? How would you really look at it, sir?
Yeah, I would suggest that, most probably the uptrend should be intact. The biggest headwind for us has been FII inflows for some time.
Yes.
And if you have rallied for around, in terms of days, it might be around 15 days, right, from the lows of somewhere around 22,000 starting of March. We have rallied continuously by 1,500, 1,600 points. So giving up 200, 300 points or a day or two of correction, I don't think it should be viewed as very negatively. A 4 or 5 day consolidation is very much on the cards. It can happen because we have already rallied 1,500, 1,600 points. One way, if you consider, we have rallied 1,200 points. So I think it's okay to stagnate a bit, take hold of things. And as you rightly pointed out, it's long weekend, F&O expiry. And next month, most probably, we will start looking at the tariffs, how they are implemented, what is announced finally. So there could be a bit of nervousness, some profit booking off the table. But as I have been saying earlier also, I think tariffs and the way the other countries have reacted to them, most probably they will have not that much of an impact on the real world. Maybe they would cause, some turbulence on the rates, etc., for a short period of time. But beyond that, we will have to see how much impact it creates. So I think, yeah, short term, medium term, 5-6 days kind of consolidation, mostly a time based correction rather than absolute correction. That is what we are looking at.
Okay. Mr. Awasthi, since FIIs are coming back, and that's a bit of a positive relief that we are sensing in the markets, but then there is this one overhang of April 2nd. How do you see things unfolding in the US? Is it going to be again just tough talk, but the implementation could be softer, or do you expect this could be a big dampener that the markets are fearing at this point in time? Because he's talking about secondary tariffs on countries like India and China again. So a lot is still at stake and the investors are nervous.
Yeah, I think with China, it's a very hard relationship, so you can't really comment much how both countries would respond to it. But in case of India, we have already been hearing that we are also considering some softness in some of the rates that we have been very rigid about.
Yeah.
And even the US would obviously, they have been saying that countries that comply or recalibrate according to the requirements, US would also be considerate about it. So I think both ways it will work around, and it will be tit for tat kind of strategy. Like we have seen many countries come back and hit back tariffs at US also, and they will also need to understand that how much of the domestic economy can take these kind of price hikes. So some industries where they want to safeguard and push production at the domestic level, they might do it in a calibrated way, and I don't think it will be a shocker kind of announcement. It will be a calibrated approach, but I think countries that can negotiate better, they will get on the table better. So I think India will be in a sweet spot. I don't think we will have much of a problem from the tariffs. Maximum a 2 3 month kind of recalibration that happens. That is something you could look at. But I think it will again be more of a talk rather than actual implementation on the ground. Actual
Okay.
implementation will be in a staggered fashion over a longer period of time.
Okay, fair point. Let's delve into a little bit of pockets, then we can come back to overall understanding of what are the key factors impacting the sentiments. I'll talk about the defense space, sir. We are seeing renewed optimism across the board, HL, BEL, BDL, even the shipbuilders, Mazicon Dock and the rest of them. They're all again coming back in flavor. Order inflows are coming back in trade. Even the delivery, which was supposed to be like a key question mark, things are improving on that account on HL as well. Do you think, of course, in the last 1 month, we have seen many of these stocks recover about 15-20% from their all-time lows as well. How would you really look at some of these stocks? Is it the right time to look at them afresh, accumulate for those who were holding at much higher levels?
Uh, Try accumulating on dips rather than running behind these stocks,
Okay.
particularly the defense and railway stocks. Shipbuilding might be in a bit of a sweeter spot because of the developments in the US in terms of tariffs and tariff on Chinese-made ships also, which dominate, the global landscape of ships. So how that is navigated and how that plays out, I think that is something that could be positive for shipbuilders largely. But how much of that culminates into business is something we will have to see. But other than that, if you look at the defense and railways particularly, I think across the board valuations would be fair and square. So 1.5 2 years, you might find it tough to make money out of these stories, unless we have a very strong risk on in the market. So I think even at current valuations, they might not be run away to the bank to just jump into buy into them. You should stagger your buying, over the next 10-12% correction as and when these stocks see that. I think that is where you would be better, particularly the defense stocks. Maybe some of the railway names would still be a bit on the expensive side. IRFC was an exception, but now since they're diversifying out of the railway business and into the private side also, so I think the NPA clauses will also trigger in. So I think most of the railway names would be fairly to squarely valued unless and until some big export orders culminate. For defense also, I think the export trigger still awaits, and once that happens, some big orders are converted that could really lead them to a different level. But 18 to 24 months, I think they would be fairly to squarely priced. So if you have a less than 3 year kind of horizon, it would be hard to make money. But if you extend your horizon to say anything between 36 to 48 months, I think that is where most of the defense stories could give you money. And Masgaon, Garden Rich, and Cochin, the shipbuilding ones, I think they could gain some benefit out of this development in the US on Chinese ships. So maybe that is one space you could keep looking at. But defense and railways, I think still, if you have an 80 to 24 months horizon, I think at these valuations, it's better to avoid, have a staggered approach, and extend your horizon to 36 to 48 months. That is where you'll be able to make decent money.
Okay, so that's as far as the defense and the railways pack is concerned. I'll also go beyond and ask about certain other pockets and stocks. Let's look at Zomato. It's dropped about 3 odd percent in trade today, back at 203 odd levels. Remember, in the last few days, we had seen its recover from 201 to 225 and beyond kind of levels. But again, the stock has been lagging behind. This is also as a result of dampening effect coming in from brokerage houses that are slashing their newer targets on Zomato further. What's your sense sense on Zomato, Swiggy, this pocket? I mean, the IPL season is on, and this was being seen as one of the key pockets of beneficiaries, with food delivery orders exponentially growing during this period. What exactly should you be really looking at when we point out Zomato and Swiggy, sir?
I think the fast delivery mechanism was something they were both betting on, the way Blinkit turned around. But now, as we have spoken earlier, also there is a lot of competition. Jio is looking at it,
Yes.
Reliance is looking at faster deliveries, Amazon is again aggressively looking at faster deliveries. They're working on some pilot projects in Bangalore also. So I think a lot of competition is trying to come in because of the success that Blinkit has been able to garner. Not to say that everyone can replicate the same thing. It's not as easy. I think to have the right mix of technology as well as the services that you provide. But I think Zomato has done a fantastic job in terms of being a first mover across many segments. So I think they deserve some premium, and right now the premium between them and Swiggy on an EV to sales basis would be what, around 30 to 40% 1 year forward EV to sales. So I think at these valuations, both would be fairly squarely valued. I think once a risk on comes back, and with these startups, you take these risks, new stories kind of story. So it is quite possible that occasionally you have these dips where competition kind of dips into your share, and you have some dip, and your forward numbers are calibrated lower, and one or two segments do outperform, and suddenly your forward numbers start looking much better. Typically, I would not bet just on an IPL season. I think that's now a regular feature, and it's part of the year. The full year guidance would not change much based on that. So I think the fast delivery and the dark store edition is something that we are looking at, and I think that space would continue to grow over the next two,
Okay.
3 years. Competition might play a bit of dampener here and there, but largely I think both these companies have a large base right now, and they are the market leaders. So I think they would be able to trail through, and I think growth rates would be very decent, 35-40%, 30-35% next year easily for both companies, and 4 or 5 times EV to sales. I think easily, Zomato could trade at 7.5, so that leaves you around what, 30-35% upside from current levels. Similarly, I think Swiggy also can easily trade at 6 times, 6.5 times EV to sales forward. So they could have 40-50% upside. So I think gradually use this dip to buy into these stories, but you understand that you are a high risk investor or trader only, then it makes sense to get into these, because by traditional metrics, I think they are still a long way in terms of being justified as viable investments.
Okay, fair point. So that's as far as the quick commerce and the food delivery space can be looked at. What's buzzing today back again is Trent. 3% higher at 5,333. Again, wanted to get a sense on something that we've also discussed before, the consumption theme and how that's going to be playing out. From 1st of April onwards, what will kick in is the tax cuts, which was supposed to be initial key trigger for the consumption to go up. Which are going to be the key beneficiary sectors? Is it going to be FMCG? Is it going to be consumer durables, or maybe retail and others as well? And how are you betting big on this space, sir?
I think it would be consumer durables. Small part would go into the FMCG part, and the clothes and athleisure kind of stuff. But I think bigger beneficiaries would be consumer durables, maybe two-wheelers, and the third could be this travel and hotel industry. I think these are the three segments that benefit most. We are betting more on the travel and tourism part of it, the younger Gen Z, and the second would be the consumer durables part of it, whether it's smartphones or some gadgets, or the consumer durables that you use at home. I think these are the two spaces, and some two wheelers maybe, or the bottom of the strata cars. I think these could be things that would benefit most out of the tax cuts.
Okay, fair point. Let's also look a little deeper to see what else can be buzzing. Today, auto space is still holding up, sir. Have you tried to spot any newer stories here? I mean, Maruti is extending its, plants and its capacities there, whereas we are hearing about SML Isuzu, a lot of M&A options, still a lot of guessing is happening, whether it's going to be Ashok Leyland or M&M, and how things are going to shape up here. Auto ancillaries are also really, coming back in full flavor. What exactly is your approach?
Yeah, I think within the frontline names, we think Tata Motors is a good bet at these valuations. Similarly, Maruti Suzuki is a good bet. Hero MotoCorp as well. I think these are the three names we are betting on. Even Bajaj Auto most probably has a 1500, 2000 rupee leeway from here in terms of our targets. So I think these are the four names: Bajaj Auto, Hero MotoCorp, Tata Motors, and Maruti Suzuki. These would be our top bets from the frontline names. From the auto ancillary space, I think Motherson Sumi is a very decent bet at these levels. We are thinking that most probably as things improve, there could be a very sharp re-rating there. Numbers next year should also be very decent. So I think Motherson Sumi could be good for targets of around 190, 200. So these are the 5, 6 stocks. Even a Varroc could be good. That has corrected substantially from the higher levels. So I think these are the 5, 6 names that you could look at.
Okay, fair point. Let's also look at some of the other pockets then. Oil and gas as a pocket is something that I wanted to get a sense, and then we'll get into commodities spaces too. Oil and gas, why? Because again, there is this news that US stockpiles have drastically dropped again. That's supporting the sentiment. So far, the news was that the US is going to be excessively drilling. That could bring down the crude oil prices far sharper. They have been cooling off over the last 1 or 2 months odd, and now hovering around $73 a barrel. What exactly would your approach be on the oil and gas space? Today, GAIL has got an approval to extend its pipeline from the gas space, so a lot of moving parts there.
See, temporary spikes here and there on crude oil is something that will happen from time to time based on demand supply equations that pan out in various areas. But largely, we are of the opinion that oil is on a downward trajectory. Occasionally, $5, $6 here and there is something that can happen. But the larger trajectory would be downwards only. So I think OMCs would continue to benefit out of that. And generally, the country, India, would particularly benefit out of lower oil prices. But said that, I think even if you consider an ONGC, which is trading at what 6 times 1 year forward, I think leaves a lot of room, 6.5% kind of dividend yield also. Ideally, we are thinking that an ONGC could easily trade at 9 times. Next year earning is 42, 43. So 3 and 3, 350, 360 is what we are looking at. So I think ONGC is a decent bet. I think similarly Oil India is a decent bet. Both these companies are working on improving the yields of their marginal oil fields. Some new finds could further bolster it. Though we are not very optimistic on the pricing side of it, but I think on balance, these companies, even if without the support of very high oil prices, they will continue to report these numbers. And based on that, I think gradually right now the mood is very somber. Once it normalizes, you could easily see these companies trading at 9, 10 times, and that would result in very decent upside from current prices. And OMCs, I said, we are bullish. I think IOC remains our top bet with a target of 190, 200. The dividend yield there is also robust. I think even if it trades at 10, 12 times, that would be the case. GAIL at these valuations again is, I don't think, very expensive. It trades at decent valuations. What, yeah, 10 times, not much growth, but yeah, you could easily look at what around 200, 210 on the stock, even if it trades at 11, 12 times. On the city gas distribution, I think IGL and NGL are very attractively valued. Our top bet, we are betting big time on IGL based on the diversification they are doing. I think that is a story that could easily clock 350, 375, and beyond that, we will again review it. And even MGL at these valuations, I think is a very decent bet. So I think the whole space, barring probably maybe Petronet, rest of it looks very attractively valued. So we are well bullish on the space. And we are also betting big time on the private name Reliance. I think that's a very good story for around 1700, 1650, 1700 on an SOTP with Geo and retail also listings happening. So I think that would be a good name to look at.
That'll be a good name to look at. Reliance Industries is something that you are looking at. All the sectors are now into the red. The markets are now in a you can actually see more weakness slipping in. 23,500 has been taken out, 184 points of a decline on the Nifty. You just have about handful of stocks, about 7, 8 stocks that are in the green on the Nifty. Rest of them have all slipped. Power space is giving us some interesting names. PowerGrid, for instance, is up and about. This entire space is again getting flavor, getting into flavor because of the summer season again and the heightened demand that there could be for the power space again. Should one look at this again as a periodic, seasonal, or short-term play at this point in time, or do you think this also has a long-term structural story to play, and therefore one can continue to accumulating year on year on this as well, sir?
Uh, yeah, I think certainly the transmission and distribution part of the business is a lot of requirement because of the advent of renewable energy. Globally, there would be a lot of expenditure to be done on that. So, as a theme, if you are looking at a decadal kind of theme, T&D could be a thing that could do very well. Within that, obviously, the name you mentioned, Power Grid, could do very well. Short to medium term or slightly medium to long term, I think what 3 times price to book doesn't leave much on the table for Power Grid. Unless and until the forward numbers become very rosy, usually does not happen overnight, takes a bit of time. So I think if you have that shorter horizon, less than 3 years, I think maybe a CSC makes sense at these valuations. What is it trading at? Somewhere around 13
Okay.
times, So CSC at 1.7 times price to book makes more sense according to me. And if the latest acquisitions that they have done, they can turn it around. That could also play out very well. But the rest of the power pack, I think, roughly fairly squarely valued. Maybe an NHPC is a good bet to look at these levels. Long-term targets are very aggressive. Similar story in SJVN also. So I think long-term growth targets are very. Either you look at companies which are slated to grow abnormally in the long term and are not that big right now, where the capex is a multitude of their current capacities. So NHPC and SJVN, these make the cut. Maybe some of the Adani stories could also play out, Adani Energy Solution. But mainly, if you want to just play safe, 1.5, 2 year kind of horizon, I think maybe a CESC could be good for targets of around 180, 190.
Fair point. We'll note that as well. We were discussing commodities, and I also wanted to discuss the cement and the metals pack, something which is allied to, the real estate story as well, sir. And how would you really look at these two aspects even at this point in time? Metals, of course, has a lot of international play, something that we are discussing, tariff talk, what happens in China, China's economic recovery. Cement, although, has a lot of integral, connotations, but of course, a lot of M&A is happening at this point in time as well. How are you playing these two themes?
See, metals, de facto, we were only looking at Hindalco because of the Novelis angle and tariffs in the US. Beyond that, I think short term, this duty safeguard that has been put does give them some sentimental support. But if I look at valuations across the board on most steel stocks, I don't think the story has something very enlightening for the next 18 to 24 months. I think they would be largely flat to negative during this period, and not much is left for them to enjoy from here onwards. At best, you could look at market linked returns. Outperformance, I certainly don't see for most metals. And the other space you said was cement. I think I've been betting on cement being on a strong revival, but over the last 2, 3 months, not much has happened. Maybe over the next 3 to 6 months, we see some revival because we are very bullish on the infra and real estate part of the business, and both are strong consumers of cement, and it is largely a domestic commodity. So one contra bet we are betting big time is Dalmia Bharat, in spite of their exposure to South India and some challenges they've been facing. I think petcoke prices have also come down. That should also aid. So I think that's a bit of positive. Some bit of mining changes and royalty changes is hitting across the board for most mining related stocks. Same for Dalmia also, but I think that's a marginal issue. And once they can, clock in the larger advantages of economy, etc., and improvement in margins, etc., they should benefit. ACC could be a good bet from here on for improvement in numbers. The frontline names, I think they are fully squarely valued, not much left on the table. Maybe a JK Lakshmi looks very good at these valuations, one of the most efficient cement manufacturers. a decent capex plan. The EV per ton, the valuation is very attractive. So I think that is one story which could have a very decent upside. Last I remember, we are working with targets of around 1,050 on the stock.
Okay, 1,050 on stock. We'll keep an eye out on that. We'll also look at some of the other pockets, broader markets, mid and small caps, and the broadest index. Any opportunities there, sir? We have been seeing a lot of volatility even in these two pockets. I mean, yesterday these were the biggest drags on the markets. We have seen a tad bit recovery in the last 6 days odd, but again today there is some softness across the board as there is. What is the right way to look at mid and small caps? Absolute stock specific should one be?
Yeah, I think you have to be stock specific because the basket is pretty large, and there are stories that will work wonders at times, and at times they might not do anything for an elongated period of time. And you have to be very specific regarding the corporate governance issues, etc. And you have to track a lot of things. Since the basket is larger, I think it's better to go stock specific rather than identify sectors and hope that everyone within the sector will do very well. So I think that's a space that where you have to be stock specific. Generic ideas will not really help because the level of corporate governance across the mid and small caps vary hugely. Not the case in most large caps, or the frontline mid caps, but the under owned mid caps and the smaller small caps. I think that's a place where this diversification is huge in terms of management quality, balance sheet quality, profitability metrics, everything.
Okay, fair point. Going forward from here, Mr. Avasti, what are the key triggers that you would really look at that helps you to understand that this uptrend is only going to grow for the better? What are those top 2 or 3 factors that can actually help in a sustained market recovery from here?
See, I think one would be global inflation and interest rates. Both are obviously linked. So we are looking at maybe lower inflation and lower interest rates. Uh, the tariffs, if they are not very hard, I think that should be viewed as a positive thing. And too much of protectionism really, or any kind of protectionism, does not really help us. It's been a long way through which we have fought it to get a globalized trading platform. Now to go back to protectionism doesn't really make sense. But all said and done, every country wants to protect its own interests. So I think interest rates, inflation would be key. Quarterly numbers we will continue to watch very closely, and next quarter onwards, I think, as you rightly pointed out earlier, also that once the tax benefits start flowing in May, June onwards, I think we'll see some improvements there also.
Okay, fair point. Well, we'll thank you then, Mr. Avasti, for being with us on the show today and helping us navigate through all of these moving parts in the markets. Hoping that today's drop only has to do with something to the volatility impact of FNO series ending tomorrow. But things get back on track pretty soon. And of course, we'll all have to keep an eye out on how things progress in the most important first week of the new fiscal year. That will have all those data points from the US to really take down into account. So this week, of course, we'll be looking back at how the year has gone by in terms of the financial calendar. But next week, we'll have to look at a lot of newer themes, sectors, and everything, all the strategies for the new fiscal year. And we'll invite Mr. Avasti back, to help us with all of those new ideas for the new fiscal year too. Thank you so much, sir. Pleasure being in conversation with you as is always, and hope you have a great time till the time we see you next. All right, 23,478. We are 191 points lower on the Nifty. It's been an absolute choppy one. We are ending those 7, winning days now, snapping that into a red. All across the board, there has been a broad-based sell-off. Nifty Bank, mid and small caps, all the sectoral indices, they all end in the red in today's trading session on the penultimate day when it comes to the FNO series of March. Autos are just like hopping on and off as far as the closing on the flat line is concerned and above it. Let's see how it shuts. But a lot of decline on the media stocks today, 2.5% gone. Real estate has lost a lot of momentum. Remember, it was one of those sectors that was actually opening higher, holding up. That's given up large part of its gains. So it's been a one-way slide. at the lowest point, 1.6% lower. Oil and gas down by 1.3%, PSU banks 1.2%, small caps over a percent cut, IT down a percent, financial services down a percent, pharma down a percent, private banks about 0.9% of a fall. Then you have infra metals, consumer durables, FMCG, slight losses across the board. On the PSU space, the index is down by 1.4%. But HAL and PowerGrid, two stocks that are holding up. Rest all of the stocks are largely on the lower end. On the Nifty, IndusInd Bank wins with 3.4% gains. Top mover on the Nifty. Trend follows Hero Moto, Grasim, PowerGrid as among those stocks that are holding up, while on the declining side, NTPC, Tech Mahindra, Cipla, BPCL, Bajaj Finance, Axis Bank as some of those stocks that are on the declining zone. Then of course, when we look at F&O space, Siemens definitely pulled up, AU Small Finance Bank, AHAL and IndusInd Bank as those top movers. Like I pointed out earlier, declining side you had IRFC, Max Healthcare, NTPC, Container Corporation of India, Union Bank of India, all of them as top drags as far as the F&O pocket is concerned today. So 3:30 p.m. the markets have frozen, in fact at the lowest point. 204 points gone on the Nifty, 23,464. So you actually see a lot of decline coming in just the last few minutes. Let's actually look at who were the index contributors on the Nifty drag. The top contributor on the declining side has been HDFC Bank. 32 points it has contributed on the lower side as far as the Nifty is concerned. Infosys has contributed 26 points to the declining side. Reliance has contributed about 22 points. Axis Bank, Bajaj Finance, all of those spaces that were in fact on a winning zone. If you notice in the last couple of days of a recovery, all of them were actually pulling the markets higher. Bajaj Finance was, Reliance was, HDFC Bank was, Axis Bank was, and all of these have turned out to be the key contributors of the decline today. Barring about 8-10 stocks which have contributed on the positive side, rest all of the stocks have contributed on the negative zone as far as the Nifty is concerned. So we definitely end the day on a negative note. Let's see how the last expiry of F&O really pans out in tomorrow's trading session. We'll wrap it up at that, but do stay tuned on to Business Today Television as the coverage beyond the stock markets continues on the world of business and economics. Stay tuned. Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is your favorite show, Daily Calls, a show that addresses all your stock related